Okay. Well, good morning, friends. Good morning, Dhyanesh, Nikita, Alok, Jyoti, great Parthasarthi, Gomti. Morning. A good, great, Mohammed. Well, what we had done in the previous lecture was setting off losses before finding out the total income of the assessee. What we had left in that lecture was clubbing of income. Before I start with clubbing, I have a question, Mohammed Aslam. When you enter something, why do I see that query 5 times or 6 times? Is there a problem with the system, or you're posting it, a couple of times? Well, good morning, Abhishek. See, friends, everything, all the planets revolve around the sun. Under the Income Tax Act, everything revolves around Section 4. Then Section 4 is a basic charge, and then you have got those small charging section for individual heads. So you've got Section 15 and then Section 28. So, and all the charging section for each of the individual head. Now, when you talk of Section 4, it levies a charge on the total income of every person, right? So, in respect of the total income earned by a person. So ideally, the charge under Section 4 is only in respect of total income of that person, not of anybody else. So it is not that your neighbor's income is going to be clubbed in your hands and would be taxed in your hands. Can't happen. But then, under special circumstances, you know, what assessees do is they've got an inherent urge to actually transfer their tax liability to somebody else. Now you would say, why would anybody, transfer his tax liability to somebody else or transfer his income to somebody else? The reason is simple. India has got a progressive tax structure. What do you mean by progressive tax structure? Well, until 2.5 lakh rupees, you have the basic exemption limit. After 2.5 lakh rupees to 5 lakh rupees, you've got 5% of tax. After 5 to 10 lakh rupees, you've got 20% of tax. And above 10 lakh rupees, you've got 30% of tax. So there is an incremental tax for incremental income. And this is the root cause of all the sections starting from section 60 to 64. So had it not been an incremental tax system or a progressive tax system, well, you would not see section 60 to 64. Had it been a flat rate of tax, like in case of companies, you have got a flat rate of tax. Like in case of firms, you've got a flat rate of tax. So in that case, it is not required. It is not required to have the clubbing provisions. Just because we have got, a progressive tax structure, do we have section 60 to 64? Now on your screen, we start with section 60. See what happens. Here we've got two people, right? Both of them are friends. So let's assume this is Mr. A and Mr. B. Now, Mr. And after you become chartered accountants and, once you come into real life, you'll have so many friends who would actually do nothing. They do nothing. They have got no source of income. So what you do is especially in India, where you've got so huge population, you'll always find people who don't have any taxable income. So you befriend them and you have got a lot of income. So let's assume Mr. A has got an income of rupees 10 lakhs, right? And now once he's got income of rupees 10 lakhs, he'll have to shell out tax to the tune of, let's say, forgetting the alternative tax regime. Let's say he would have to shell out 1,12,500, isn't it? 1,12,500 plus the education cess. So roughly it would be 1,17,000 rupees. Now, if he were to pay 1,17,000 on his income of rupees 10 lakhs, what he does is he meets B and tells B, boss, you don't have any income. What we'll do is we'll divide my income 50-50, right? So instead of I paying tax on 10 lakh rupees, I'll pay tax on 5 lakh rupees and I'll transfer some income to you, the benefits of which I'm going to utilize. 5 lakh rupees of return you pay tax on, and 5 lakh rupees I'll pay tax on. Now, what is the tax on 5 lakh rupees for an individual? For an individual on 5 lakh rupees, you pay nothing because of the operation of section 87A. We'll come to it, as the lecture progresses. But because of 87A, you don't pay any tax. Mr. A ends up paying zero tax. Mr. B, anyways, which did not have any income, and therefore he also doesn't pay any tax. Now, this is something, I have to stop. As an income tax officer, or as a government, I would not encourage a transaction like this, where there is transfer of income without transfer of asset. And therefore, you have got section 60. What does section 60 says? All income. So it deals with all kinds of income. So it is not just, salary income or interest income. It deals with all income arising to any person by virtue of transfer, whether revocable or not. So what is happening here is where there is transferred income. So in case of B, there is a transfer of income from A. A has transferred his income to B, right? And therefore, by virtue of that transfer of income, B is earning 5 lakh rupees. Shall if there is no transfer of asset, so a transfer of income without a transfer of asset would be chargeable to income tax as income of the transferor. So even though A had transferred 5 lakh rupees, assuming that of a rental income, to his friend B, yet that 5 lakh rupees would be taxed in the hands of the transferor, meaning A. So it would be included in the income of the transferor. So now, now you are in a tizzy, that even if I transfer the income without transfer of asset, it's going to be of no use. And therefore, I'll find a way out, isn't it? Now, all the assessees would want to find a way out. So what A would do here, A would say, okay, transfer of income without transfer of asset is going to be clubbed. Let me transfer the asset also. But then transferring of asset would mean, he would have to actually give the title to B. And if A and B are very good friends, in every probability, B would not return back the asset. And therefore, what he does is he transfers it to B, but there is a revocation clause included in such transfer. So like A would say, okay, this asset belongs to B, but I can take it back whenever I want to. So if there is such revocation clause included in an agreement, in such case also, even though there is transfer of asset, yet the income would be clubbed in the hands of the transferor. So that provision is contained under section 61. So revocable transfer means revocable transfer is defined First, we understand what is revocable transfer. Revocable transfer means transfer if it contains any provision. So if there is any provision in the transfer agreement for retransfer directly or indirectly of the whole or any part of the income or of the asset. So either it is income or asset. If you retransfer anything, if you retain the right to retransfer either the income or the asset itself in the name of the transferor, it is treated as a revocable transfer. See, understand this. Very easy, simple to understand. A had transferred his asset to B. However, he retains the right to take it back. You lend something to somebody, you always retain the right. Here, what he's doing is he's not lending, he's actually transferring it to B, but again retaining the right. So in substance, he has only what he has done is he has devised a colorable mechanism to actually transfer the income without actually transferring the asset. So in substance, the asset is not transferred, therefore it is deemed to be revocable. So either he keeps a provision for retransfer of the asset, or we are talking from the point of view of the transferor, or in any way gives the transferor a right to reassume power. So there should be some right to reassume power in respect of income or the asset. So there might not be a right to retransfer that asset, but the power, the control over that asset could be transferred to A. Even if that is so, it would be treated as a revocable transfer of asset. So section 61 deals with such revocable transfer where there is actual transfer of asset and, the transferor has got the right to revoke that transfer. Section 60 deals with only transfer of income and no transfer of asset. Section 61 deals with transfer of income along with a revocable transfer of asset. In both the cases, clubbing provisions would apply in case of any person. So it would be any person, if he indulges into revocable transfer of asset, that the income arising from such revocable transfer would be taxable in the hands of the transferor. Let's move ahead. I hope this is clear. Now what could happen in some genuine cases? In some genuine cases, a transferor would want to actually transfer the asset, but only give a life interest to the transferee. So until and unless the transferee is alive, the transfer holds good. Once the transferee dies, that the transferred asset would be retransferred to the transferee, to the transferor. See, understand. I'll just explain you. Like in the same example, going by the same example where you've got A and B, what A does is A transfers his asset to B with a condition that during the lifetime of B, during B's lifetime, the asset would remain with B only. But once B dies, the asset that has been transferred, say, let's say a house property, a house property has been transferred from A to B, and until B is alive, B could retain the house property. Once B dies, the asset would be again transferred to A. Now, this is genuine transfer. This is where, B gets a life interest. So if B gets a life interest, in that case, though it is revocable, see, it is revocable. The condition but is that on the death of B alone, it would become revocable. So section 62 contains an exception to section 61. Section 61, mind you, had barred all the revocable transfer. However, here under section 62, you've got one exception. And that exception is if the transfer is irrevocable for a specified period. So it is revocable, but it is irrevocable for a specified period. And that specified period is the lifetime of the transferee. Are you getting my point, friends? So the provisions of section 61 shall not apply. Say it says it starts with a saving clause, an exception clause. It says that the provisions of section 61 shall not apply to any income arising by virtue of a transfer, arising by virtue of a transfer by way of trust. So what A does, let's say, we'll just change the case a little bit. What A does, A has got a small kid, Master X. Now, for the benefit of Master X, what A does, it transfers some of his fixed deposits to a trust, to a trust. All of you would have seen movies, and in movies there is this brat child and a dying father. What he does is he creates a trust and puts a trustee on that particular trust, wherein that trustee has to take care of this kid until he becomes a major, right? So now what has happened here is A has created a trust. So it could be any person, not just minor. Let's say Master X is a friend of Mr. A. Now that trust is created and the asset is transferred. The fixed deposit is an asset there. Asset is transferred to the trust, and that trust is not revocable during the lifetime of the beneficiaries. So until Master X is alive, it would not be retransferred to Mr. A, or any of his legal heir. So for the entire lifetime of Master X, he would be the beneficiary. So if that is the case, section 61 would not apply, even if it is revocable at a later stage. It is irrevocable during the lifetime of Master X. Similarly, so either you by way of a creation of a trust that the transfer takes place, or by any other mode. So it is not necessary that there should always be a creation of a trust. You could transfer an asset directly from A to B, and during the lifetime of B, the asset would be enjoyed by B. Thereafter, once B is dead, it would be retransferred back to A. So that could happen. Okay. But then, see, always, whenever act gives a concession, that concession would come up with a condition. And the condition here is that the transferor should not derive any direct or indirect benefit from such income in either cases. So either he creates a trust, or he transfers it to B. He should not enjoy that property which has been transferred. So during the lifetime, if you have transferred anything, a life interest has been given over the asset, you should not be in a position to enjoy that asset or the income arising therefrom. If you are able to enjoy it directly or indirectly, in that case, it would be treated as a revocable transfer only. Yes, and then section 61 would apply. Are you getting it, friends? So two very, very simple provisions: transfer of income without transfer of asset to be clubbed in the hands of the transferor. Transfer of income, transfer of asset, but revocable at the option of the transferor, again clubbed in the hands of the transferor. However, transfer of an asset for the life of the transferee, during the lifetime of the transferee, well, that is not to be clubbed, provided there is no direct or indirect benefit arising to the transferor out of such transfer. Yes. Let's take up a small example. I'll just share a small example with you. By that time, I would just look at the queries also, if there are any. Okay, is it visible, friends? Okay. Well, so an unequivocal A is what I get. So yes, the option is indeed A. Now, see what has happened here. What has happened here is Jyoti and Priyanka are friends. Jyoti transferred her rental income without transfer of the house property to Priyanka. So 25,000 rupees per month have been transferred from Jyoti to Priyanka without transfer of asset covered by section 60 of the act. The total income before clubbing is 10 lakh rupees and 13 lakh rupees. Now, see, understand here, Priyanka's income is more than Jyoti's income. And therefore, department would be well off, taxing this in the hands of Priyanka herself. But then, see, it is a mandatory provision to club it in the hands of the transferor. And therefore, it has to be clubbed in the hands of Jyoti only. So it doesn't matter whether whose income is more or whose income is less. Even if the department would have got advantage by taxing it in the hands of Priyanka, yet it would be taxable only in the hands of Jyoti. So there is no discretion to anybody. The provisions of clubbing are mandatory provisions. What I mean to say is this. Now, there is one question whether an asset that has been transferred, you know, by the transferor to the transferee during the lifetime of the transferor. So, if an asset is transferred only for the lifetime of the transferor, clubbing provisions would still apply. So, yes, sir. A point that is important here is it should be for the lifetime of the transferee and not the transferor. So, in our example here, if Mr. A would have transferred a particular asset, for the benefit of Master X, due only for the lifetime of Mr. A and not lifetime of Master X. In that case, such transfer is not covered by Section 62. So you won't get an exception as far as clubbing is concerned. It should be transferred, you know, for the lifetime of the transferee or the beneficiary. Yes, I hope you're getting it. Now, moving further. So, notwithstanding anything contained in subsection 1, all income arising to person by virtue of transfer shall be chargeable as income of the transferor as and when the power to revoke the transfer arises. So, logically, so see what happens. During the lifetime of B, the house property would be held by B. Now, during his lifetime, the entire income is going to be taxed in the hands of Mr. B. Once he dies, the power to revoke would arise in the hands of Mr. A. And therefore, after the death of Mr. B, income arising from that particular asset would be taxed again in the hands of Mr. A, who was the transferor. Good. Now, moving further, Section 64. Let's deal with Section 64. This is a separate, Section 64 is different from 61 and 62. 60, 61 and 62 is applicable to all the person, right? So it could be, a friend, some other family member. It could be any person whatsoever. However, in case of Section 64, it deals with particular persons. And it deals with individuals. See, look here. Section 64, subsection 1, in computing the total income of any individual. So it talks of individual alone, and therefore it becomes more and more important from your examination perspective. See what it says, in computing the total income of any individual, there shall be included all such income as arises directly or indirectly. So all such income that arises directly or indirectly would be included in the hands of the individual, right? In respect of such income relating to spouse of that individual. So income of spouse being taxed in the hands of another spouse. So in case of husband, wife's income taxable in the hands of husband, or in case of wife, husband's income taxable in the hands of wife, right? So spouse of the individual by way of salary, commission, fees, or remuneration. See, we are talking of what? We are talking of salary, commission, fees, or any other form of remuneration. So this is very, very specific set of income. It does not take into account any other income apart from what is contemplated. So here only four kinds of income have been contemplated. One is salary, commission, fees, or remuneration, whether in cash or in kind, from a concern in which such individual has got substantial interest, right? So let's assume there is this husband. He has got a business, he runs a proprietary concern. It could be anything, it could be a proprietary concern, it could be a partnership firm, it could be a company. But let's assume he is running a proprietary concern and he's got a wife, right? Now, what he does, he's got business income to the tune of, let's say, 15 lakhs. Now, 5 lakh, incremental 5 lakh is taxable at the rate of 30%. And therefore, what he does is he transfers 50,000 rupees as remuneration per month to his wife. Now, if 50,000 rupees is transferred to his wife per month, the total remuneration would be 6 lakh rupees for the year. And now what would happen? The husband's income would come down from 15 lakh rupees to 9 lakh rupees, and therefore he would not fall under the 30% bracket. The wife could, easily go for deduction under Chapter 6A and reduce her income from 6 lakh rupees to 5 lakh rupees and end up paying no tax on the amount. In order to, mitigate this kind of a situation, what they've said, if there is an individual and if any salary, commission, fees, or remuneration is paid to the spouse of the individual from a concern in which the individual has got substantial interest. So what is substantial interest? We'll come to it in a short while. But understand, only from a concern where the spouse has got substantial interest. In such a case, the remuneration which have been paid from the concern would be taxed in the hands of the individual himself. So in our example, this 6 lakh rupees would be clubbed in the hands of the husband. However, it further gives an exception. And this exception is in case of a genuine remuneration which is paid to the spouse. So nothing in this clause shall apply in relation to any income arising to a spouse where the spouse possesses technical or professional qualification. So, if the spouse is technically qualified and if any amount is being paid by in form of salary, commission, or any other remuneration, that part of remuneration which arises out of such technical qualification and out of the special knowledge which the wife has got, that is not going to be clubbed, right? We'll take an example and you'll understand this anyways. But then remember, salary, commission, fees, remuneration would ordinarily be clubbed in the hands of the spouse who has the controlling or substantial interest. But then if the spouse is technically qualified and by virtue of that technical qualification, if any salary, commission, fees, or remuneration is paid, in that case, no clubbing provision would apply. Now, the point is, see what could happen. There could be an individual who has got substantial interest. He pays some amount as remuneration, and we are going to tax it in the hands of that individual. But sometimes both could have substantial interest in a particular concern. Both husband and wife, both have got substantial interest. Before we move on to this explanation, we understand what is substantial interest. So substantial interest is already explained in explanation 2. See, for the purposes of clause 2, an individual shall be deemed to have substantial interest in case where the concern is a company. See, the concern is a company, concern could be a partnership firm, concern could be a proprietary firm. So it could be in any form. Now, if a concern is a company, the individual holding at least 20% of the voting power. So there should be 20%, at least 20%. So 20% or more of voting power. Usually voting power you'll get by way of an equity share, right? So mere preference shares to the extent of 20% is not going to be of any help. Equity shares of 20% would grant you voting power. If you've got 20% of the voting power at any time during the previous year, you have got substantial interest in the concern. So let's assume Mr. A is a shareholder in company XY Limited and holds 25% of equity shares, which would grant him obviously 25% of the voting power. In that case, any remuneration which is paid from XY Limited to Mrs. A, that would be clubbed in the hands of Mr. A. So simple, right? Equity shares of at least 20% of the voting right at any time during the previous year owned beneficially by Mr. A. In that case, he would be deemed to have substantial interest. Now, if the concern is not a company, in case of company, you'll have voting power. In case of, in case of a concern like partnership firm or, a proprietary concern, you would not have voting power. And therefore, in such cases, if a person is entitled to at least 20% of profit, so at least 20% of profit. So either 20% of voting power or 20% of profit. Now what could happen? See, there is one situation wherein a person, let's say A, has got 10% voting power or equity shares, Mr. A. And there is, brother of Mr. A, let's say X. X has got 15% of voting power. In such a case, A together with his relative, A together with his relative has got more than 20% of voting power. Now, this situation is also covered. So what it says is either Mr. A holds at least 20% of the voting power, or he holds partly, and partly of such 20% is held by any of his relative. Now, what is relative? Relative here is defined, is not specifically defined, and therefore wherever relative is not specifically defined, we go to section 2 into bracket 41. 2 into bracket 41 deals with relative, and it says in relation to an individual, it would mean husband, wife, brother, sister, or any lineal ascendant or descendant of that individual. So simple definition, it is not complicated at all. Unlike section 56(2), where you've got a list of relatives, here it is very, very simple. They say it's husband, wife, brother, sister, or any lineal ascendant or descendant of that individual. So if, here in our example, Mr. A together with brother of Mr. A, that is Mr. X, if both of them together are holding more than 20%, at least 20% of the voting rights, in such case also it would be deemed to be a substantial interest concern, right? And once it is a substantial interest concern, any remuneration that is paid from such concern in which an individual has got substantial interest to the spouse of such individual, it would be clubbed in the hands of the individual. Now, what could happen? See, what could happen is both the husband and wife, both the spouses would have substantial interest. Mr. A also has got substantial interest. Mr. A, let's say there is a firm, partnership firm XY, right? And Mr. A has got a profit share of, let's say, 32%, Mr. A. And his wife, let's say Miss X, she has another 25% of profit share in the firm, and there are some more partners. So both of them have got substantial interest in the firm, isn't it? By virtue of more than at least 20% of the voting power, both of them, without any doubt, have got substantial interest. Now there is some salary commission fees that is being paid by the firm to both the partners. Now where do you tax it? In such a case, they say, for the purposes of clause 2, individual shall be husband or wife whose total income, excluding the income referred in clause 2, is greater. So clubbing would be applicable in such a case where the total income of the partner, of the individual or his spouse, is greater. Let's assume here Miss X has got a greater income. She has got an income of 50 lakh rupees, whereas Mr. A has got an income of 10 lakh rupees. In such case, Mr. A's income in form of salary commission fees from the firm would be taxed in the hands of Miss X, because her income before clubbing is greater than that of her husband. Right? Do you get this, friends? So whoever's income is greater, it would be taxed in the hands of that particular partner, that particular individual. Now, see any questions? Okay, clubbing notes are not uploaded. Well, I'll see to it that those are uploaded. I'd uploaded it yesterday. I don't see a reason why you don't see it. Well, asset transferred, which was an asset for scientific research, scientific purposes. What Kojima wants to ask is, if at all a deduction under section 35 is taken on a particular asset, well, that is not the subject matter here. It would be governed by section 41 and not 60 or 61. Okay, just check this short MCQ. Okay, Alok. See, I hope the MCQ is visible. Okay, Mohammed says it's B. Alok says it's Alok himself. Alok, you seem to want a higher total income. Okay, so we've got Anand who says it's B. Somnath says it's B. So a lot of A. So, okay, Kavita says it's C. Whoever's income is higher. And Sandeep says it's B. So most of you have answered it as B. See, understand the question. Mr. Alok holds 22% in shares in Tech CA Limited. Now, Tech CA Limited, becomes a concern with substantial interest, right? So there's no dispute as far as Alok has got substantial interest in the company. His wife is a software engineer. Now isn't she professionally qualified? She is indeed professionally qualified. Once she is professionally qualified, friends, see, we have got a provision in place which says that nothing in this clause shall apply in relation to any income arising to a spouse where the spouse possesses technical or professional qualification. Now, once the spouse has got technical qualification and the income is solely attributable to application of her professional knowledge, in that case, it becomes her individual income, right? So it would be taxed in the hands of wife of Alok only. The reason being it arises out of her professional qualification. The salary is not taxable in the hands of Alok, or it is also not taxable in the hands of whoever's income is higher because of technical knowledge. Well, wonderful. A lot of you have answered it as B, and that is correct. Well, whether the definition of relative um, under section 241 would include son and daughter. I've got a query whether it would include son and daughter. The answer is yes. See, we are talking of all the lineal ascendant and descendant. So relative includes relative for the in relation to an individual would mean husband, wife, brother, sister, right? Or any lineal ascendant or descendant. Now, who are the ascendants? Well, it is father, grandfather. Those are ascendants. Who are descendants? You've got son, daughter, granddaughter. Those are descendants of that individual. So it is covered. Right? I hope the query is satisfied. Right. So yes, friends, most of you got it right. It would be taxed in the hands of his wife and not Alok, though Alok has got substantial interest. Now, what happens? We are talking of clubbing in the hands of spouse who has got a higher income. Now, income in our case got to be computed every year. Every year you will compute income and then you'll opt for clubbing. But then they say then it becomes a very difficult exercise to do. Therefore, they say that once a particular source of income is taxed in the hands of the spouse, taxed in the hands of the spouse who has got higher income, in subsequent year, it would continue to be taxed in the hands of the same spouse. So you're not going to change the spouse just because he has got a lower income in the subsequent year. Meaning what? Let me just explain you briefly. See, Mr. A and Mr. B, we did see an example. Mr. A and Miss X, both are husband and wife. Both have got substantial interest, assuming, right? Both of them had substantial interest in XY. Now, in year one, in the first year, while the clubbing got attracted, income of Miss X was higher, and therefore the remuneration paid by XY Limited or XY firm to Mr. A was actually clubbed in the hands of Miss X in year one, since her income was 50 lakh rupees before clubbing and A's income was only 10 lakh rupees before clubbing. What happened was, in year one, it was taxed. This remuneration paid by XY Limited was taxed in the hands of Miss X by virtue of Section 64. Now, once it is so done in the hands of Miss X, if in any subsequent year, if even if Miss X has got a lower income, you know, even if she's got a lower income, still it would be continued to be taxed in the hands of Miss X, right? The provision is contained in explanation 1 alone, where any such income is once included. Now, this is, this is a common phenomenon across Section 64. Once an income is included in the income of either spouses, any such income arising in any succeeding year or any subsequent year shall not be included in total income of the other spouse, right? So it shall continue to be taxed in the hands of the same spouse, unless so only if the assessing officer is satisfied, after giving an opportunity to the spouse, that it is necessary to change the spouse. So in a very remote condition, in a very remote case, would it be changed after the first year? It would continue. So it is not that revenue would get an advantage by taxing A's income in the hands of A, and therefore revenue wants to change the clubbing which was done earlier. That cannot happen. So it would continue to be taxed in the hands of Miss X only. Let me just let us go through an example. I'll just share an example. See, could you see this on screen? Okay, Somesh, is it applicable in case of associate company, and if such company is OPC, then what is the conclusion? See, associate company, you're talking of, a company having substantial interest in another company. That is not governed by Section 64. Here we are talking of substantial interest of the individual. So company to company having substantial interest, it has nothing to do with Section 64. Individual having substantial interest in another company. So in case of OPC, 1% company, yes, that individual is going to have substantial interest. I hope your query is clear, Somesh. I've clarified your doubt. Well, yes. A lot of A's. Mohammad Abid says it's B. Virat. Dhruvi says it's A. Okay, Priyanka says it's Anushka A. So a lot of A's. Some of you have answered B. Khushi has answered it as D. Well, let me tell you, A is the right answer. It is certainly not D. assessing officer has got no option except for, in exceptional situation, after giving opportunity of being heard alone, could he change the spouse in the hands of whom clubbing was done earlier. In this case, what has happened, Virat and Anushka, both of them have got substantial interest in Vamika Limited. Their salary was clubbed earlier. So salary that was received from Vamika Limited by both Virat and Anushka was clubbed in the hands of Miss Anushka for the previous year 21-22. The reason was, obviously, once it is clubbed, the reason would have been that Miss Anushka would have had higher income. In the lockdown year, Virat did not have more cricketing income, and therefore it was taxed in the hands of Miss Anushka. In previous year 22-23, where he had a wonderful season, Virat had higher income before clubbing under section 64(1) IB. The salary will now continue to be clubbed in the hands of Anushka only and not in the hands of Virat. Do you get it, friends? Yes. So I hope the concept is clear. Now, so see here, what happened in this clause 2 was 64(2). The spouse deriving only a few sources of income, like salary, commission, remuneration, fee, that was being clubbed. What about the other income? So other income is covered by clause IV, section 64(1) IV. It deals with, transfer of asset to spouse of the individual. See, to the spouse of such individual from asset transferred directly or indirectly, subject to the provisions of section 27 clause I. Now, section 27 deals with deemed ownership. I'll just briefly share what section 27 said, but for the timing, understand where the asset is transferred by an individual to his spouse. See, to his or her spouse, husband transferring asset to, husband transferring asset to wife, or wife transferring asset to husband. Now, these kind of transfers are actually, colorable devices only. Why would husband transfer asset to wife or wife transfer asset to husband? Because they are family. So, whatever happens, it stays within the family. And if it stays within the family, the transfer is fine. So where the spouse, I therefore want to nullify the effect of such transfers. How do I nullify it? I say that if a spouse has transferred an asset without adequate consideration, husband has transferred asset to wife without adequate consideration, in that case, the income arising from that asset would be taxed in the hands of the spouse who has transferred the asset. Simple. So see, look here, for the first time, I'm talking of adequacy of consideration. Prior to this, I've never talked of adequacy of consideration. So whether the consideration was adequate or not inadequate in case of revocable transfer of asset, clubbing was mandatory. Here, though, we have got an exception. If husband and wife carry on a commercial transaction at an arm's length, at an arm's length means at adequate consideration at market value of that particular asset. In that case, clubbing would not apply. However, if husband transfers an asset to wife for an inadequate consideration, in that case, clubbing provision would apply. So any income that arises on asset which have been transferred from husband to wife, income arising on such asset would be taxed in the hands of husband and vice versa. However, what it does not cover a situation already covered by section 27. So 64(1) IB does not cover a situation which is already covered by section 27. Now what section 27 covers? Section 27 covers income from house property. See, look here, I'll just I'll just briefly show you what is section 27. Just rewind it a little. Section 27 deals with owner of house property defined. So for the purposes of section 22 to 26, an individual who transfers for inadequate consideration any house property, an individual, so husband transferring house property to wife for inadequate consideration, not covered by clause IV. It is covered by section 27. So in that case, clubbing would anyways which happen, but then their husband is deemed to be the owner of that house property, right? To his or her spouse for inadequate consideration, or not being a transfer for agreement to live apart, or to a minor child, not being a married daughter. So remember this, we are, we are restricting our discussion to clause I of section 27. Section 27 deals with, deemed ownership in case of transfer of house property for inadequate consideration to spouse of the individual or to minor child of the individual, not being a married daughter, right? Now, therefore, all other assets apart from house property, would be, would be governed by this clause IV. Then, so I hope you're getting this. Income is going to be clubbed in the hands of the spouse who has transferred the asset for inadequate consideration. There is one condition that, would allow you not to club the income. And that condition is where the asset is transferred in connection with an agreement to live apart. Sometimes what happens is in a marriage, both husband and wife decide to live apart or they get divorced. Now, if any asset is transferred by virtue of such an agreement to live apart, in that case, clubbing is not to be done. So it's a genuine transfer. Then, to son's wife of such individual. So own spouse or to the wife of son. So let's say two individuals, they've got a son, they've got a major son, and this major son has got a wife. Now what they do is they transfer an asset, either the father-in-law or the mother-in-law. They transfer asset without adequate consideration to son's wife. Even in such case, since we've got a patriarchal system and son stays, within the family, and therefore such transfer to son's wife would again mean the asset is within the family, and therefore they say any transfer of such asset to son's wife would again be taxed in the hands of the transferor. So either in the hands of father-in-law or mother-in-law of this son's wife would it be taxable if the transfer is for inadequate consideration. I hope you're getting it. Simple. Then there's one explanation. Now what could happen? See, there is Mr. A and there is Mrs. A. Now Mr. A transfers, let's assume 5 lakh rupees to Mrs. A. What has happened? There's a transfer, a gift flowing from Mr. A to Mrs. A of rupees 5 lakh rupees. Now this 5 lakh rupees would not give any income as such. There would be no direct income of 5 lakh rupees. Have you seen money grow, right? 5 lakh rupees of cash given to Mrs. A and tomorrow it becomes 6 lakh rupees. That is not going to happen. So on this 5 lakh rupees, there is no direct income flowing to Mrs. A. But this 5 lakh rupees which Mr. A has given to Mrs. A have been invested by Mrs. A in a business. Now this business is going to give profit to Mrs. A. Now this profits are arising out of the gift or the amount given without adequate consideration, and the profits would be taxed in the hands of Mr. A. Right? Getting this? Now, how do you tax it? So they have given a manner in which such income got to be computed. So wherever there is a transfer of asset from an individual to his spouse or son's wife, and such asset which is transferred is invested by the spouse or son's wife in any business. If it is so invested in such business, in that case, the income from business would be prorated, or you will have to compute proportionate income to which is to be clubbed in the hands of the individual who has transferred the asset without adequate consideration. Now, how do you calculate the prorated income? Well, the clubbing would be, the clubbing of the income would be income from business. Let's say income from business. In this case, we're talking of Mr. A and Mrs. A. We continue with the same example. Let's say the income from business is 6 lakh rupees in case of Mrs. A. Mrs. A earns 6 lakh rupees from her business, and the gifted amount was 5 lakh rupees. 5 lakh rupees is the amount of gifted asset, or the asset given without consideration or inadequate consideration. And her total investment in the business, let's assume her total investment in the business is 10 lakh rupees. Now what happens is, of the total investment, 5 lakh rupees flows from Mr. A. So one half of her investment is out of the asset transferred without adequate consideration, and therefore one half of the 6 lakh rupees, or the proportion of 5 lakhs divided by 10 lakh rupees, would be taxed in the hands of Mr. A. In other words, 6 lakh rupees multiplied by 5 lakh rupees, that is the investment out of gifted asset, divided by total investment, which is equal to 3 lakh rupees to be clubbed in the hands of Mr. A. Do you get this, friends? Everybody? Very simple. So clubbing would be only that of prorated income. Now understand here, the investment got to be computed on the first day of the previous year, and not the last day or the mid of the previous year, or not the highest amount or the lowest amount. They say amount invested as on the first day of the previous year. Now, generally, in case of individual, how do you find out the amount invested? You find out the amount invested by looking at the capital account. What is the balance of the capital account? That is my investment in the business, right? So total investment done by the spouse as on the first day of the previous year in the business, out of which how much have been invested out of gifted property, right? As on the first day of the previous year. Do not forget this, as on the first day of the previous year. Now, what happens if at all, a particular spouse gives some amount in the middle of the year? If some amount is given in the middle of the year, well, that would not be included. So, for the first time, Mr. A gave 5 lakh rupees to Mrs. B, on, let's assume, 15th of August. Now it is in the middle of the year. My first day of the previous year was 1st of April, and therefore the amount invested out of gift would be zero. Though it was eventually invested into the business, yet it would be treated as zero, and no clubbing provision would attract for the first year if the amount is given in the mid of the year. Do you get my point, friends? So that is explanation 3, wherein you got to find out prorated income. See, what could happen? Either Mrs. A invests into her own business, or alternatively, what she could do is she's a partner in some firm and she takes the money and invests it into the firm. If she invests the amount into the firm, she'll get interest from that firm. So whatever interest she would get from the firm would be clubbed in the hands of Mr. A on prorated basis. So like income from business, she'll have interest from firm that would also be clubbed on a prorated basis. Now you would say Mrs. A would also receive profits from the firm. Whether that should also be clubbed, well, it becomes immaterial because profit from firm is anyways which exempt under section 10 to A of the Act, and therefore there is no such formula for transfer of prorated profit. What has been included or what has been covered by section 64 is only interest received from firm where the investment is done in the firm out of gifted property or asset transferred without consideration. Right? Getting this, friends, everybody? Let me just move you through an example. Let's check out an example. Okay, is the MCQ visible? Okay, Mohammed, I'll tell you what adequate consideration is. See, a consideration for a transfer of asset would be treated as inadequate if it is not done at market value. Meaning what? अगर आपको कोई asset transfer करना है, if you were to transfer some asset, on an arm's length basis, just because you have transferred it to your spouse, you have a particular amount. Let's say since Mr. X has transferred it to Mrs. X, he has charged less amount. Had he transferred it to an independent buyer, what would have been the consideration? I find out adequate consideration by testing it. Had the transaction took place between two independent buyer and seller, what would have been the price? If the price would have been 10 lakh rupees, adequate consideration is 10 lakh rupees. Just because it was a transaction between husband and wife, the transfer took place at 5 lakh rupees. So what is the inadequacy there? The inadequacy is that of 5 lakh rupees. Getting my point? Now, there could be a question. See, let's assume there is a asset that has been transferred from Mr. X to Mrs. X for inadequate consideration. So 10 lakh rupees of us bonds were transferred for 5 lakh rupees. And now that 10 lakh rupees of bonds which were transferred earn you an interest of 1 lakh. So whether I need to club entire 1 lakh in the hands of husband, or whether I need to, I need to club only 1/2. That is the amount of inadequacy. See, what was the inadequacy? Inadequacy was only 1/2. 5 lakh rupees asset, 10 lakh rupees worth of asset transferred for 5 lakh. Inadequacy is only 1/2. So should I, club only prorated or proportionate income, or should I club the entire 1 lakh? Well, there's no straight answer to this question. There is nothing in the act which gives for a prorated clubbing. It got to be an entire amount. Wherever transfer of asset have taken place otherwise than for adequate consideration, it would be clubbed in the hands of the spouse who is transferring such asset. So technically, taking a ultra technical view, it would be entirely taxed in the hands of husband. Sometimes what happens is, sometimes a husband would transfer um, asset in form of bonds. What the wife would do, take the bond and liquidate it, and she would invest in shares. Now the wife would say bond was transferred for inadequate consideration, but I'm not getting any income from bonds. I've converted that asset into shares. Even the dividend arising out of that shares would be clubbed. So even if the asset have changed forms, yet clubbing provision would apply. So it is not a case where the asset has changed form and clubbing provision doesn't apply. Okay. So I've got a few answers here. Jyoti says it's A. Alok says it's C. Danish says it's D. So I've got all the answers. Nobody for B, I guess. Nobody's mooting for B. So certainly out of question, taxable in the hands of Mr. Ron before marriage, but not after marriage. Okay, nobody is mooting for B. Somnath says it's A. Okay. So some of you have answered A, some of you have answered C, and some of you have answered B. Sorry, D. D. Nobody has answered it as B. See, let's see how it goes. Mr. Ron transferred 2,000 shares of Hogwarts Limited to Miss Hermione without any consideration as a gratitude for saving his life. Right. Later, Ron and Hermione got married. So, see, understand here, first and the foremost thing, whenever you're reading a question, the sequence of event is transfer took place before Ron and Hermione got married. So once the transfer has taken place prior to the marriage, prior to subsistence of marriage, they are not spouse. They can't be called a spouse. And since the transfer had taken place prior to they getting married, nothing is going to be clubbed in the hands of Ron. So prior to the transfer, if the marriage subsists on the date of transfer, only then can clubbing provision be enforced. But since the marriage was not in subsistence, no clubbing provision would apply, and therefore the answer here would be C. Taxable in the hands of Miss Hermione before and after marriage. C is the correct answer. Why A or B or D is not incorrect? The reason is because there was no marriage, and since there was no marriage at the time of transfer, no clubbing provision got attracted. However, section 56(2) would apply. 56(2)(10), that is going to be applicable. Do not forget that. Yes, I hope it's clear. Is it clear, friends? Why C? No, it's not B. See, let's go by the section. What the section says. Whether transferred is made to spouse of such individual. Whether on the date of transfer, Hermione was spouse of Ron. The answer is no. Since she was not spouse, no clubbing provision would be attracted. For those who are saying B, why it is not B? The reason is they were not married on the date of transfer. Similarly, after after there's a divorce that took place between two individuals, any transfer post divorce would not be taxable, would not be clubbed. Yes, let's move on further. Then VII 7, clause 7 and clause 8, to any person or association of person, where if an asset is transferred to any person or an association of person by an individual otherwise than by way of an inadequate consideration, otherwise than for adequate consideration, to the extent to which such asset is for the benefit of his or her spouse or his son's wife, right? See what could happen. The individual X and Mrs. X, they come to know that there is something called a 64(1)(IV). If Mr. X transfers a property from his kitty to Mrs. X without adequate consideration, the income arising on this asset would be taxed in the hands of Mr. X only. So there is no point transferring the asset to Mrs. X directly. And therefore, what Mr. X does, Mr. X finds a friend, or an AOP finds a friend, let's say B. He transfers it to B. And what B does, so it's an irrevocable transfer from X to B. And what B does, B transfers the income arising therefrom to Mrs. X. Now, this is a transfer which has taken place only for the benefit of Mrs. X. So if it so happens that X have transferred it to B for the benefit of Mrs. X, it would still be clubbed in the hands of Mr. X only. So it says when a transfer is taking place to a person or association of person for inadequate consideration for the benefit of his or her spouse or son's wife, in that case, clubbing would be done in the hands of that individual only. I hope it's clear. Then, moving further. So we have already talked of spouse of the individual and son's wife of an individual. Now we come to minor child of that individual. See, minor child means, either it could be son or daughter, minor son or minor daughter. In fact, here there is no distinction between, minor daughter and minor married daughter. Unlike section 27, which created, another entity, minor married daughter. Here there is no such distinction. And child would mean in relation to an individual, it is defined under section 2(15)(b). It includes stepchild, adopted child of that individual. So his own child or stepchild or an adopted child would be covered here. So what it says, in computing the total income of any individual, there shall be included all such income. There shall be included all such income. See, we are talking of all income. So not just remuneration or income arising out of a particular asset. We're talking of all income. It's a plenary section. All income is covered. So it could be interest, it could be remuneration, it could be business profession, lottery income, etc. Anything which accrues or arises to a minor child. Now, minor child meaning 18 years, less than 18 years, is a minor child. Not being. So it says not being a minor child suffering from disability of the nature specified under section 80U. So if it's a special child, it's a case of a special child, that income are accruing or arising to the special child would be taxed in the hands of the special child only, right? So one who has got some disability which is covered by section 80U will come to 80U. You'll understand what kind of disability. Generally, it is permanent disability or disability of a grave nature. We'll come to it in a short while. But then understand minor child suffering from disability not to be clubbed in the hands of the parents. Further, nothing contained in this subsection shall apply in respect of income accruing to minor child out of manual work or activity involving skill, talent, specialized knowledge, or experience. So, assuming some of you might be below 18 years of age, and let's say you get into articleship, although not practically possible, but yet if it does so happen that there's a minor who gets into articleship, gets some stipend. Now that stipend is not going to be clubbed. Why? Because it is out of manual work, or out of the skill, talent, and specialized knowledge, experience of that particular individual or that particular child. So, or let's say there is a child actor. Now that child actor would get some remuneration. That remuneration is by virtue of the work or the talent that the child possesses, and therefore no clubbing would be done in the hands of the parent. It would be taxed in the hands of minor child only, right? Do you get it, friends? Now, in whose hand should it be taxed? The question is, you've got, mother and father. In whose hand child belongs to both? So in whose hand? They say, obviously, when it comes down to Income Tax Act, I'm going to check my benefit. My benefit is to tax it in the hands of the parent whose income is higher before the clubbing. So I'm going to, where the marriage of the parent subsists. If the marriage does not subsist, in that case, wherever the child has got the custody, whoever parent who has got custody over the child, I'm going to club in that parent's hand. But where the marriage of the parent subsists, it is to be taxed in the hands of that parent whose total income is greater. Simple. Where it does not subsist, where the marriage does not subsist, it is one who maintains the minor child. Then, similar to the spouse, where we saw that once it is added in income of one spouse, it would continue to be clubbed in the hands of that spouse only. Similarly, here, once it is added in the hands of either of the parents, it would be clubbed in the hands of that parent only in subsequent year. Do you get it, friends? Yes, simple, very simple. So unless and until the AO is satisfied after giving parents an opportunity of being heard that it is necessary to change the parent, no, the parent cannot be changed, and it would be clubbed in the hands of the parent who for the first year had higher income. Yes. Let me just give you an example. Okay. Yes. All right. What is assessing office? AO is assessing officer. Assessing officer or an income tax officer. The Act uses the term assessing officer. Okay, Jyoti says it's C. Pranav says it's C. Danish, Somnath, well, Parthsarthi, all of them say it's C. So simple, yes, because of his special talent, know-how, skill, or any manual work done. If a minor has received any money, some income, that is not going to be clubbed in the hands of either of the parents. So it is not to be clubbed in the hands of parent when the income arises out of specialized knowledge, skill, know-how. But then if the income is such which does not require any specialized knowledge, etc., or manual work, in that case, it is going to be clubbed in the hands of that parent who has got a higher income. So in this case, yes, the answer is C. Let's move further. So we are into the last leg of this particular chapter. We'll take a short break after that for 5 minutes. See, where in case of an individual being a member of a HUF, right? So where an individual is a member of a Hindu undivided family. So now see this particular subsection 2 operates only for limited assessees. One, those who are first members of those who are Hindu and they are members of a Hindu undivided family. So if individual is a member of Hindu undivided family, and what he does, he converts his individual property into a HUF property. So let's say Mr. X has got his individual property. What he does, he pools it into HUF. Now this HUF has got co-partners and members. So you have different co-partners. So all male members would be co-partners, and female members would also be co-partners. Wife would be member of this HUF. Mrs. X would be a member of this HUF. Now what he does, he transfers bond of rupees 10 lakh, let's say bonds of rupees 10 lakh in HUF. Now these bonds which are transferred for inadequate consideration, otherwise than for adequate consideration, any income that arises, let's say these are 10% bonds. So now income would come to HUF of rupees 1 lakh. Now this 1 lakh would be clubbed in the hands of Mr. A only and not in the hands of HUF. It would not be taxed in the hands of HUF, but it would be taxed in the hands of Mr. A. Why? Because the transfer of bonds have taken place for an inadequate consideration. Now, what could happen after this? After he has transferred bonds to HUF, the HUF undergoes partition. And once the partition takes place, each of the member would get a share of this bond worth rupees 10 lakh. So, whoever are members of the HUF or the co-partners of the HUF, they'll get their share, isn't it? So if this HUF had, let's assume, wife, major son, minor son, who were the members of this HUF, they'll all get a share in the partition property. Now, once the share is received by any other members, in that case, the clubbing would stop. Understand? The clubbing would stop because now it is not a property which has been transferred, or the HUF is not earning any income, and therefore there is no question of clubbing. And therefore, in order to mitigate this situation also, what they have said that in case if such partition takes place where the converted property, the individual property got converted into HUF, and where the converted property is the subject matter of partition, in that case, the income derived from such converted property as is received by spouse. So if some part of it, let's say, out of this 10 lakh rupees, 2 lakh rupees of bond were received by spouse of Mr. A. In that case, 20,000 rupees, since those are 10% bonds, understand, 20,000 rupees would continue to be clubbed in the hands of Mr. X. Similarly, if there was a minor child who got another 2 lakh rupees of bond, that minor child income arising on the bonds which are there with the minor child, that would also continue to be clubbed in the hands of Mr. X. But all the other co-partners, there would be no clubbing taking place. So whether converted property is partitioned and some part of it is received by spouse on partition, that would be clubbed in the hands of the individual. Right? Getting this, friends, everybody? So simple. I hope it is clear. See, remember one thing, income on income. What could happen? There is a transfer of bonds from Mr. X to Mrs. X of rupees 10 lakhs. 10% bonds of rupees 10 lakhs. On these bonds, Mrs. X is earning 1 lakh rupees of income. Now, this 1 lakh rupees is going to be clubbed in the hands of Mr. X. However, if Mrs. X further invests this 1 lakh rupees of income in shares and earns a dividend of, let's say, 50,000 rupees, assuming she has earned dividend of 50,000 rupees. Now, whether this dividend should also be clubbed in the hands of Mr. X, the answer is no. Income, arising on income which has been clubbed is not to be clubbed. Understand? It could be a little confusing, but then income on income is not clubbed. What is clubbed is the primary income, 1 lakh rupees to be clubbed in the hands of Mr. X, but not the secondary income which arose on this investment of 1 lakh. Right? Getting this, friends? Similarly, what could happen? There could be a planning. I'll just share an example. See here, you've got a planning that has taken place. See what happens here. Irfan and Yusuf. Okay. Could you see it on the screen? Yes, Somesh, you're right. After partition, the income arising on the share of Mrs. X and minor son would be clubbed. Okay, Vimal has a very interesting question. He says, when skilled minor child earns money from acting and that money is kept in fixed deposit, the interest income which the parent, whether that would be the interest income on such fixed deposit, whether it would be clubbed in the hands of the parent, the answer is yes, it would be clubbed. Only what is not going to be clubbed? The income that arises out of special skill. That's all. Also remember one thing, there is something called as section 1032. Then 1032 gives exemption in respect of income of each of the minor child, which is clubbed under section 64(1)(a) to the extent of 1500 rupees. A big 1500 rupees of exemption is given for each of the minor child. So if a particular assessee has got 3 children, for each of the children, he gets an exemption up to 1,500 for the entire year. Okay. See, look, I have shared this MCQ only to show you circuitous transaction. How can transactions be rotated? See, Irfan and Yusuf are brothers. During 20 to 23, Irfan gives house to Yusuf's wife. So what has happened? Gift has flown from Irfan to Yusuf's wife worth rupees 40 lakhs. Now, this happened without consideration since it is a gift. After some time in the same previous year, Yusuf transfers shares of IPL Limited worth rupees 40 lakhs to minor daughter of Irfan. Now here, see, there is an indirect transfer. We have been talking of transfer of asset directly or indirectly, right? So it is indirect, and therefore even the circuitous transaction, see, from asset transfer directly or indirectly. So these are indirect transactions. Even these transactions would attract clubbing, and therefore the rental income and of house and dividend income shall be taxable in the hands of B only. I mean to say Irfan and Yusuf respectively. So B is the right answer. Yes, sir. A lot of you have got it right. B is the right answer. Similarly, so just look at this example. Mohammed gifted 100 shares to his wife Zara on 1/10/2015. Yes, I see Mohammed is happy. He is gifted 100 shares on 1/10/2015. She received bonus shares from the company in April 2018. Let's say 200 bonus shares. She received 200 bonus shares from company in 2018. All shares were sold to a friend Harshit for rupees 5 lakhs. The capital gain on sale of shares would be chargeable to tax. Whether, see now what has happened. Muhammad has gifted. Gifted means inadequate consideration. Now, if you gift a particular asset or when you transfer asset to spouse for inadequate consideration, the income arising therefrom is going to be clubbed. What has he transferred? He has transferred 100 shares. Now, income arising on this 100 shares would be clubbed, but income on income. So, what is the income that he has received? One is the bonus shares, and two is the capital gain on sale of these 100 shares. Primary income is going to be that. But any income that arises on income, so that is not going to be taxed. What is income on income here? The bonus shares. Bonus shares which have been sold by Zara is going to be taxed in her own hands. What is going to be taxed in the hands of Muhammad is only the primary income, which is capital gain arising out of 100 shares. So the answer is D. For 100 shares, capital gain taxed in the hands of Muhammad. 200 shares, capital gain would be taxed in the hands of Zara. So it is D. The answer is D. Yes. Some of you got it right. What I wanted to emphasize to you is that income on income is not to be clubbed. What is to be clubbed is only primary income. Okay. So that brings us to the end of clubbing. Let's take a short break of 5 minutes and come back again. We'll start with deductions. Thank you, friends. Come back again in next 5 minutes. Subhashish Patro. Now, what Subhashish is saying, Subhashish says that there's a transfer from Mr. A to Mrs. A of a property, of a land. Mrs. A is getting rental income from such land. Now, the transfer had taken for inadequate consideration while their marriage was subsisting. Now, that is to be clubbed. There's no problem. But later on, Mr. A and Mrs. A got divorced. Now, whether still that income would be clubbed? The answer is no. Friends, see, either at the time of transfer, so at the time of transfer, the marriage should be subsisting, and even at the time of receipt of income, the marriage should be subsisting in order for the clubbing provision to be attracted. So, if either of it is missing, if the asset was transferred prior to marriage, no clubbing provision. Similarly, if at the time of receiving income, the marriage is not subsisting, then there is no clubbing to be done. Do you get it, Subhashish? I hope the query is resolved. Danish, in respect of your query, it is the answer is yes. Now, let's move to the next chapter, deduction from total income. Now, these deductions are provided, these are special nature deduction. When you talk of the deduction under Chapter 6A, largely they could be classified into deduction in respect of certain payments. When you make some payments, you can claim deduction. Now, these are over and above the deductions that you claim under individual heads of income. So, special deductions which you can avail on making certain payments. Similarly, there is deduction in respect of certain income. The source of income would determine the deduction to be availed. Right? There are some special section in Part C of Chapter 6A which deals with certain income which are deductible under the Act. So understand the difference between this deduction and exemption is that exempt income does not enter the computational machinery at all. So exempt income is not going to be included in any of the heads of income. Whereas deductible income would first be included in the total income of the assessee, and thereafter a deduction would be granted. Right. And then there are certain other incomes where deduction is given. So three broad classes. One is deduction on payment of certain sums. Now these sums which are paid by an assessee, he'll get deduction as an incentive to make the payment. See, in India, you do not have a social security net. Unlike the Western countries where, government has a strong social security network. If a person does not have income, they'll take care of him. If a person goes old, all healthcare, etc., all the facilities goes for free. But in India, because of the population, because of the geographical limitation, because of economical limitation, you don't have a strong social security network, and therefore government want to encourage certain investments. Government want to encourage certain payments to be made by individual, and therefore special deductions have been granted under this particular class of deduction. We'll get to it in a short while, but understand the logic behind giving those deduction. So if once you understand the purpose of the deduction, you'll understand the provision more accurately. The deductions under Chapter 6A are contained in section. Okay, I think it should be a little. or better, are contained in section 80C to 80U. The provisions are contained under section 80C to 80U. Now, these deductions are to be allowed out of the gross total income of the assessee. So first, what you do is you add up, you find out headwise income. Thereafter, what you do is you club the income of the assessee. Then you set off if you've got any losses. And thereafter, you aggregate all of the heads to find the gross total income. Out of that gross total income, thereafter, you are going to claim deduction under section 80C to 80U or under chapter 6A of the Income Tax Act. Now, these deductions are normally allowed, but they are not allowed out of income which are subjected to special rate of tax, like the long-term capital gain under section 112. No deduction out of that long-term capital gain would be allowed under section 80C to 80U. Similarly, STCG or winning from lotteries or income from under which is taxable under series of section of 115, 115A, AB, AC, AD. So those sections where the rate where the income is taxable at special rates, generally the deduction would not be available. But for all other purposes, for all normal income, the deduction under chapter 6A would be out of the gross total income. Now, what 80A further says, 80A says that the aggregate amount of deduction shall never be exceeding the gross total income. So you would, you can at max claim deduction to the extent of your gross total income. Meaning what? The total income would never be negative because of you claiming deduction under chapter 6A. Either it would be zero or it would be positive. Do you get it, friends? Yes. Now, further it says where the assessee fails to make a claim of deduction under this particular head, for any deduction under section 1010A. Now, 1010A is governed by a separate, chapter, but then still the provisions are contained here. 10AA is something a little relevant, but otherwise, most of it is not relevant. Under any provision of this chapter, under heading C. See, look here, we are talking of heading C deduction in respect of certain income. I already told you that deduction under chapter 6A could be classified into three different heads. One is deduction on account of making payment. Two is deduction out of income because of the fact that you have earned certain income. And three is miscellaneous. So when deduction is given in respect of certain income, then filing of return is compulsory. See, filing of return is compulsory only and only if you're claiming deduction under heading C, where the deduction is provided in respect of certain income. I'll just show you what heading C of chapter 6A covers. We'll just have a look at it. See. So most of the heading C is not covered by your syllabus, thankfully. And a lot of provisions under heading C have already seen sunset. Meaning what? No further deduction is now available under those sections because they have been replaced by 35 AD. 35 AD now takes care of deduction. See what has happened over the past few years. Government has moved from profit-based deduction to investment-based deduction. We want to incentivize more investment rather than more profits. Earlier, it was more profit-based deduction. So what used to happen, assessee would increase the profit of those units where deduction was available or exemption was available and move the profit from normal business to these businesses where deduction was there. And therefore, they moved from profit-linked deduction to investment-linked deduction. Therefore, we see sunset for something like a 80IA, IBA. When you look at them, this is an extract from your module itself. If you just read the heading, you'll get what kind of deductions were available. Some of them are still available, like the startup. So ATIAC is still in operation. It hasn't, it would just see sunset. Then, so deduction from housing project, deduction from infrastructural development. Now, most of it is covered by Section 35 AD in specified businesses. Now, these all deductions, if you were to claim these, you would have to file return of income. As far as your examination is concerned, you've got ATJJAA. JJAA deals with deduction in respect of new employment created by an enterprise. So if an enterprise creates new employment, they could claim deduction under ATJJAA. We'll come to it as we proceed further, but this is something which is covered. Similarly, what is further covered is, for your examination under this heading C, is ATQQB, deduction in respect of royalty, and ATRRB, deduction in respect of royalty on patents. So patent and textbook, these are the two sections which are covered, and in addition to ATJJAA. So 3 sections out of this heading. Rest of it is not covered, so we need not worry about it. But for the time being, understand, if you were to claim any deduction under heading C of chapter 6A, you are required to file return of income. Return of income would be must. Then, what if you don't file return of income? They say you will not get deduction under those particular section. You can claim deduction under other section, but not under those section where you necessarily got to file return of income. Thereafter, where a deduction under any provisions of this chapter under heading C is claimed and allowed, where you already have got deduction under heading C, you have been claiming that deduction and you have been allowed that deduction, then you cannot claim deduction under section 35 AD again in respect of that business. Simple. You are not to claim deduction under 2 different sections for the same source of income. So they say no double deduction, and it is the thumb rule of taxation that you are not going to claim deduction twice. Similarly, you are not going to be offering an income twice for taxation. That goes without saying, but it is specifically included in subsection 7, where they say if a particular income has been subject matter of deduction under heading C, in that case, no further deduction would be allowed under section 35 AD or vice versa. Then, section 80 AB deals with, again, heading C. We have already seen 3 sections which are covered by your syllabus. It says that deduction would be allowed only to the extent such income is computed in accordance with the provisions of the Act and included in the gross total income of the assessee. Only to the extent of income maximum are you going to get deduction under this heading. So if you're not computing a particular income under and not including it into gross total income, well, no deduction would be given. Maximum deduction would be the amount of income. As we proceed, you'll get the relevance of this section 80 AB. Further, one important aspect is section 80 AC, which have been an off late development in respect of all the sections of of chapter 6A. See what it says. No deduction under heading C would be allowed. So heading C deals with only those items of deduction which are related to specific income. No deduction shall be granted unless the assessee furnishes a return of income for that assessment year before the due date of filing return under section 139(1). So now necessarily, if you were to claim benefit, any profit linked incentive or any specific deduction, you will have to file return of income before the due date of filing return. So due date would be, in case an assessee is subjected to audit, it would be 31st of July. And in case an assessee who is not subjected to audit, it is 31st of July. If an assessee is subjected to audit under the Income Tax Act or any other provision under any other law, the due date is 31st of October. If you fail to furnish the return within this time allocated, in that case, you lose the deduction. So very harsh provision. Sometimes there could be a huge deduction that is available, usually for cooperative societies, which are governed by Section 80P. Now, that is not covered by your syllabus, but then, how it could happen. Let's say a cooperative society has got an income of 1 crore rupees, which is deductible under Section 80P, which is covered by heading C. Now, if that cooperative society does not file return within time, if it is a belated return, or if the return is not filed at all, well, the entire 1 crore rupees of deduction is lost, and they'll end up paying tax. Do you get it, friends? Now, what is gross total income is defined under 80B subsection 5, which says that it means total income computed in accordance with the provision of the Act before making any deduction under this chapter. Let's take up a MCQ before we set up section 80C, which is one of the very important sections under this chapter. Okay, I hope the MCQ is visible. Okay, there's a query whether if an individual has opted for 115 BAC, which is the alternative tax regime. If you have opted for alternative tax regime, friends, only a few deduction under this chapter is available, like 80 CCD2. I'll come to it in a short while. As we go further, I'll tell you which deductions are also available under the alternative tax regime. Most of the deductions are not available, but then, a couple of them, like 80 CCD subsection 2 and 80 JJAA, that is available irrespective whether the assessee is following alternative tax regime or the new tax regime. Okay. So yes, I've got a lot of answers. Ganesh says it's D. Subhashish says it's D. Sujal says it's D. So most of you, yes, it's indeed D. Piyush, it's D. Option is D. Deduction under Chapter 6A is not available out of income falling within, which is classified as long-term capital gain under Section 112 or 111A, or winning from lotteries under Section 115BB. These are all taxable at special rate of tax. And therefore, there's a specific bar in these sections only. When you read Section 112 or 111A, you'll find a specific bar on claim of deduction under Chapter 6A in respect of these income. So if an assessee has got income which is, in the nature of long-term capital gain and also normal business income, in that case, he can claim deduction out of normal business income, but not out of long-term capital gain. So D, yes, all of the above. Now, deduction in respect of certain payments. See, as far as deduction in respect of payment is concerned, I've already told you that government wants to incentivize certain payments or certain investments. And therefore, as a measure of social security or as a measure of incentive in special cases, certain set of deductions have been prescribed. In the line of those deductions, Section 80C happens to be one of the most important and widely used provisions. When you think about this particular chapter, you won't have usually you would not have a complete problem on Chapter 6. Usually, I'm not assuring you anything. But then what happens is you could always have a small adjustment. Man, it's very simple to get an adjustment on Chapter 6. In any of the problem which deals with total income, where you are required to find out total income of the assessee or tax liability of the assessee. There you would find, a very small adjustment on Chapter 6A, and that adjustment you could do only if you know the provisions right. Now, ATC deals with life insurance premium, deferred annuity, contribution to provident fund, subscription to certain equity shares or debentures, etc. So if you go by the heading, you'll understand that these all payments are related to social security of an individual. By social security, what I mean to say is, a post-retirement or post the death of the assessee, there are certain needs which the family could have, or the post-retirement and assessee could have, and therefore, in order to ensure that he meets those requirements, incentive have been given. Now, in computing the total income of individual or HUF, see, we need security only for families and individual, and therefore, this entire provision is applicable only to individual and HUF and not to companies, etc., company, firm, etc. Right. Now, what it says, there shall be deducted in computing the total income of the assessee, being individual or a HUF, there shall be deducted the whole of the amount paid or deposited, the whole of the amount paid. So amount should be paid or deposited in the previous year, being aggregate of the sums referred to in subsection 2. So whatever amount is paid in respect of items provided in subsection 2, a deduction shall be allowed to the extent of rupees 1,50,000. So maximum deduction under ATC is what they've given. It is 1,50,000. Now what subsection 2 says, what are the items of payments? Any sum paid or deposited in the previous year, for as life insurance premium. So as life insurance premium to keep in force insurance on life of a person specified in subsection 4. Now, what is this subsection 4? Subsection 4 defines family. Family for this payment of premium would mean individual himself. So it is individual himself. So he takes his own life insurance. To his spouse. So spouse would mean, husband or wife, or any child of such individual. Right. So what it does not cover father, mother, brother, sister, lineal, ascendant, descendant. What it covers is only individual, spouse, and child. So if the assessee takes his own insurance of his wife, and insurance of his children, and makes a payment of premium for such life insurance, in that case, the amount of premium paid would be deducted. But have I not said that ATC is also applicable to HUF? So if it is HUF, if the family takes insurance, if the HUF takes insurance of any of the members, right? In that case, the HUF can also enjoy the benefit of deduction under ATC. Do you get it, friends? So life insurance premium paid by an individual for his own insurance, spouse or child, or any member of the HUF would be subjected to deduction. But then what it says is, this contract of insurance should be in the nature of insurance only. See how it goes. There is a sum assured in every insurance policy. Now, what is this sum assured? Let's say on a particular event, let's say on death of that individual, a person would receive 1 crore. This is nothing but insurance, right? The amount insured in case of life of that specified person. Sum assured is 1 crore. This is nothing but the real insurance. Now for ensuring that 1 crore rupees is paid on death of that particular individual, this particular individual would pay insurance premium. Now, see what the Act says. Act says that you should not pay more than 10%. You should not pay more than 10% in premium. So if it is a policy of 1 crore, the maximum premium that you should pay is only 10 lakhs. Now, what if you pay more than 10 lakhs? If you pay more than 10 lakhs, then the maximum deduction that you could claim would be 10 lakhs. Although, it would be restricted to 1,50,000. But do you get this point? The point here is, see what could happen. I'll tell you why this provision has been brought in. Let's say a person takes an insurance of rupees 50,000, sum assured 50,000. And he's paying a premium of, let's say, 1 lakh. Now, in this case, you would say, oh, how foolish is it? 50,000 rupees of sum assured and 1 lakh rupees of premium. Who would pay this? What happens is, in such a case, this 1 lakh rupees is given to the insurance company as an investment. So it would be returned at a later date. Any amount that is received from insurance company is exempt under section 1010D. And therefore, a lot of people, what they did is they took insurance and they made investments, and whatever they received was exempt from tax thereafter. And therefore, the sum assured was kept low so that the premium is not much, and the entire amount would get into investment of that particular individual. At the time of maturity, entire amount would be exempt. In order to cap it, what they did is, prior to 1/4/2012, the limit was 20% of the actual sum assured. So maximum premium that you could pay was 20% of the actual sum assured. So in this case of 50,000 rupees of sum assured, the maximum payment, if this policy was taken prior to 1/4/2012, so up to 31st of March 2012, had this policy been taken, the maximum premium that a person could pay was 10,000 rupees. But post 31st of March 2012, that is from 1/4/2012, this 20% have been brought down to 10%. So maximum premium for a sum assured of 50,000, a person can pay a premium of only 5,000 rupees. Now, what if this person X pays premium of 15,000 rupees? In that case, only 5,000 rupees would be available as deduction. Right? Do you get this, friends? Everybody? So, prior to 1/4/2012, if a policy is purchased, the limit was 20%. After 31st of March 2012, the premium amount, the permissible premium amount was reduced to 10% of the actual capital sum assured. But then they realized that there are a few individuals with special needs, where the risk of that individual is higher, and therefore they end up paying higher amount of higher amount of premium. Like, say, for instance, a person who has got disability. Now, there the risk involved in insuring that person is more, and therefore the insurance company would charge more premium. In those cases where a person has got disability, so either the individual himself or the spouse or the child of that individual or any other member of the individual, if he has got some disability which is defined, which is prescribed under ATU, or he has got some specified diseases which is covered by 80DDB, in that case, so these are grave chronic diseases like neurological disease or renal diseases. A lot of the list is big, huge enough. We will discuss it when we discuss 80DDB. But for the time being, understand either it is a person with chronic disease or with permanent or grave disability. In that case, 10% of permissible premium is substituted by 15% of the permissible premium. So 15% of the the sum assured could be paid as premium. So if let's assume 1 lakh rupees is the sum assured, in case of normal individual, you can pay 10,000 rupees of premium and it would be allowed as deduction. However, if a person is either disabled or suffering with chronic diseases prescribed under section 80DDB, in that case, you could pay 15,000 rupees as premium. I hope you're getting it, friends. See, 10% is the total amount of premium. Somebody had asked whether it is monthly or yearly. 10% is the total premium on that policy. Then, so this is the first aspect, life insurance. If at all premium is paid to secure life of a particular individual, spouse or child, it is allowed as deduction under 80C. Similarly, if it is a contract of deferred annuity, if annuity is secured. Now, what is annuity? Annuity means annual payment. Generally a person on retirement would want some annuity to be given to him on a periodical basis, like pension or pension on annual basis, or a fixed sum on a periodical interval. If at all an annuity is secured and you make investment when you are young and you get the annuity when you are old. So if at all you're making any such payment to secure the contract of annuity, that payment towards that annuity policy would be allowed as deduction. Similarly, annuity in respect of salary payable to government servant, out of the salary of government servant, if any amount is paid towards an annuity plan, in that case, it would be allowed as deduction under 80C, so far as it is not more than 20% of the salary. The contribution should not exceed 20% of the salary. Then, contribution to statutory provident fund. Now, when you were learning the head of salary, you saw different kinds of provident funds. So it is statutory provident fund, employees provident fund, section 10, 11, section 12, 10, 12 is what you have seen at the time of discussion of salary. If any individual contributes any amount to statutory provident fund, that is deductible under 80C. Usually, those employees of central government, they contribute to a statutory provident fund under the Provident Funds Act 1925. Any contribution made, any employee's part of the contribution is deductible under 80C. See, it is the employee's part of the contribution, not the employer's part. Employer's part is anyways which exempt, but no separate deduction is given. Whatever is the employee's portion would be deductible under 80C. Similarly, contribution to any public provident fund, PPF. You would have heard about this, PPF. Now, see, employees would contribute to statutory provident fund or recognized provident fund. For those who are not salaried employee, for them, you've got something called as the public provident fund, PPF. It can be used by both salaried employee as well as non-salaried employee. Now, if any contribution is made by an individual for himself or spouse or children, right? So it is a section 4 family deduction. Section 4 provides for definition of the family, in which it covers number 1, individual himself, spouse and children. See, it does not cover anybody else. Do remember, it does not cover parents, brother, sister, etc. It covers only 3 members. And if you open an account in name of either the individual, spouse or child of the assessee, any contribution made to that account would be allowed as deduction. Similarly, recognized provident fund, RPF, you have already seen this while you discussed salary. Amount so employees contribution to RPF, well, allowed as deduction under 80C. Similarly, employees contribution to approved superannuation fund. Superannuation means retirement approved superannuation fund. If you're contributing anything as an employee, that amount is deductible under 80C. Now, subscription to Sukanya Samriddhi account. Now, when you look at all these payments, you realize that they are either for your own security or, post retirement, you could enjoy them. And therefore, most of these payments are promoted by the government, and therefore you get a deduction under 80C. Now, Sukanya Samriddhi account. Well, I know this list could be a little boring. I understand. I completely understand it. But then see, you got to know what is covered by 80C. 80C has got a long list of payments. It is not very difficult to remember them. Once you understand the nature of it, you would easily recognize that yes, this particular item is deductible under section 80C. We'll just go through the list once so that you at least understand what is the nature of payment. Sukanya Samriddhi account is in respect of a girl child. Post 2015, there was a lot of promotion of Beti Padhao, Beti Bachao, etc. And therefore, in order to secure a girl child, deduction was granted in form of contribution made to Sukanya Samriddhi account, where contribution is made by either of the parent in the name of the girl child, and on once the girl child gets to the age of 21, that account would mature. So you could the maximum amount that could be contributed to both Sukanya Samriddhi and Public Provident Fund is 1,50,000 under those schemes. So Sukanya Samriddhi account scheme, which is notified by the government, do not allow more than 1,50,000 rupees of contribution, so maximum contribution. Similarly, NSC, the National Savings Certificate. National Savings Certificate, if you buy these NSCs, you can claim deduction under 80C. One point to remember in case of National Savings Certificate is that if at all, there is some interest accrued. See what is the nature of this certificate? You can go to a post office and buy National Savings Certificate. Those National Savings Certificate are for a term of, let's say, 7 years. In 7 years, they would become double. So 10,000 rupees of certificate you've got, and after 7 years on maturity, you'll get 20,000 rupees. Let's assume that. So in the meantime, for the 7 years, you will also get interest, isn't it? On the National Savings Certificate. Now, this interest would accrue each year and would be taxable under income from other sources. So it is taxable interest. But the best part of this National Savings Certificate is whatever interest is accrued is deemed to have been reinvested in National Savings Certificate only. So if at all, you get an interest of 500 rupees on 10,000, in the first year, you get interest of 500 rupees. In that case, this 500 rupees is deemed to be reinvested in National Savings Certificate, and you could claim deduction of this 500 rupees also. So apart from the investment, you could also claim deduction of the accrued interest. Then you've got unit-linked insurance plan. Unit-linked insurance plan deals with insurance plan which makes investment in share market. So it is more of equity investment by the insurance agency. So they take insurance and they also invest into the stock market. That kind of a plan is called unit-linked insurance plan. Here also, the provision is clear. You need not make a payment of premium exceeding 10% of the total sum assured. So unit-linked insurance plan taken by an individual for himself or for the family member like the spouse and the children would be allowed as deduction. Then, so annuity of LIC, annuity plan of LIC. We have talked of annuity earlier. So even if you take an annuity plan of an insurer, that is allowed as deduction. Equity linked saving scheme. Now, this is an important item wherein a lot of people claim deduction in respect of equity linked saving scheme and life insurance. Life insurance deals with insurance. However, in equity linked saving scheme, there is no insurance element. What happens is you've got mutual fund, and in that mutual fund, you invest amount. The amount that you invest in that notified mutual fund would be available as deduction. What is notified? It is the equity oriented mutual fund. Equity oriented mutual funds which are notified over here. Specific schemes of mutual fund, generally you will come across them as tax savers. So if it is a tax saver scheme, only then deduction would be allowed. Let's move. So, okay, I'll take some queries. Whether there is any limit for deduction in respect of Sukanya Samriddhi, I've already told maximum deduction per account could go to the tune of 1,50,000 only, maximum. But overall limit is 1,50,000 in any case. Then, pension fund, any contribution to pension fund of set up by a mutual fund would be allowed as deduction. Now, these are all funds. See, when you just have to read them a couple of times, you'll remember. These are all funds which are in the nature of ensuring social security for an individual. Then there are certain deposit schemes of a public sector company. Public sector, the government would want to promote a particular public sector company or an authority which is into housing accommodation. See, agencies like HUDCO, Housing Urban Development Corporation. Now, those are, those are engaged in slum rehabilitation. Now, they require money. How do you get money? Government would give them, notify them as an agency who would collect deposits. The deposits would be eligible for deduction under ATC. So only since it is a tax saving deposit, would you go and invest in something like a deposit scheme of HUDCO, isn't it? So deposits in long-term finance, in public sector company providing long-term finance for construction of houses, or authority engaged in providing housing accommodation. Similarly, now let's move to the next big thing. It's education. So all of the earlier ones were either social security or deposit. Here we have got payments of expenditure, personal expenditure. So any amount paid as tuition fees, excluding any payment towards development fees, donation, etc., whatever is paid towards tuition fees only, to any university, college, school, or other educational institution for full-time education. See, whatever is paid as tuition fees for full-time education to a university, school, or college is deductible in respect of persons specified in subsection 4. So who is specified in subsection 4? In case of an individual, any two children of such individual. What is specified is only two children, right? Assessee himself is not specified. Spouse of the assessee is not specified. What you can claim is tuition fees paid for any two children of such an individual in respect of fees for university, college, school, or other educational institution for the purposes of full-time education of any such person. Right? Do you get it, friends? Only tuition fees is allowed and not development fees or donation. So if you pay donation, that is not going to be allowed. What is allowed is only tuition fees. Right? Do you get it, everybody? Now going further, residence. So we dealt with social security. We've dealt with one item of payment expenditure in respect of tuition fees. Now, any payment made for purchase of residential house property, or construction of house property in the nature of repayment of installment of loan, right? Repayment of installment of loan would be allowed as deduction under 80C. So idea is to promote acquisition of property, construction of property by an individual who takes loan in respect of purchase or construction of that house property. Now, when you take loan, you will have to repay. If you repay, what you do is you pay installment. Now, in this installment, what you have got is the principal portion and the interest portion. The interest portion of the installment in respect of a residential house property is covered by section 24B. So you are not going to get any further deduction again under 80C. However, the principal portion, whatever principal you repay, would be available as deduction under 80C in respect of a residential house property. Only residential house property is something that is covered. Now, that loan could be taken from a development authority, or a company or a cooperative society, from central government, state government, cooperative bank, National Housing Bank, Life Insurance Corporation. There's a long list of it. Any loan taken, see, in essence, where if you go by the list, what you'll realize is, if you take a loan from other individual and you repay it, that is not covered by 80C. What is covered by 80C is, if you take a loan from organized lenders. If it is a case of organized lender and you are making a repayment, the repayment of principal is going to be deductible under 80C, subject to a maximum of rupees 1,50,000. Similarly, stamp duty, registration fees and other expenses which are paid for the purposes of acquisition of the property. When you acquire the property, you have to pay stamp duty of the state government, you have to pay registration fees of the state government. Those items of stamp duty, registration fees and other expenses in relation to purchase of the property would be allowed as deduction. So residential house, you're buying it and you're paying stamp duty, that is allowed as deduction under 80C. Usually this item of deduction would be available only in the first year, right? There would be no further stamp duty that you would pay. In the first year, usually there would be no installments. There is some gestation period, and therefore installments you will repay in the subsequent year. Those installments would be allowed under 80C in the subsequent year. However, stamp duty, etc., usually in the first year. But it shall not include. What it shall not include? It shall not include any admission fees, cost of shares, initial deposit. When the assessee buys those shares or pays an admission fee to a housing society, well, that is not covered. What is covered here is you buy the property. You want to become a member of a cooperative society or a company. The amount that you pay, that is not going to be covered here. What is going to be covered here is only the installment that you pay for repayment of loan, or the stamp duty, or the registration fees that you pay to acquire the asset. So what is not covered is admission fee, cost of shares, etc. And what is also not covered is the cost of renovation, alteration. What is covered is only the cost of purchase, the loan taken for purchase of the property, loan taken for renovation of the property. That is not going to be deductible. So like 24B also makes a distinction between renovation and purchase of the property. For purchase, in case of self-occupied house property, it gives a deduction of 2 lakh rupees. However, for renovation, etc., it gives a deduction of limited to the extent of 30,000 rupees only. Here, in respect of loan taken for renovation, if you are repaying any installment, well, that is not deductible. Only in respect of purchase and construction. Do you get it, friends? Everybody? So this is residential house. Well, that's all. We've got a few more items. We'll discuss it in the next lecture. I think the time is up, and I guess reading the list at times could become a little boring. But then understand there are a lot of items. If you read it a couple of times, you'll get a nick of it. Once you see an item in problem in the exam, you'll immediately know what is to be done about this. It's not that dead difficult, but then what I've also done is, for the sake of it, I could completely understand that this entire provision, it's a huge big provision, and therefore ATC might seem a little complicated over here, and therefore I've given you a summary of ATC in the notes also, where you have got those summarized items which are of an important nature. All of them are covered in that list, so you can always have a small adjustment on ATC in one of the problem, although the provision is so big. But then a couple of reading would make you very, very comfortable. If you understand the logic of it, it's not that difficult to understand the provision. Simple. The maximum deduction that you could get under ATC is 1,50,000. That's all. I hope you guys are enjoying it. I don't know. It's a one-way communication, and therefore at times it could become a little difficult to make you understand a particular provision, since I don't get a feedback from you. I'm trying my best, friends. I will try and make it more simpler. Don't worry about it. Overall, we have got another 2 lectures for deduction. We'll take up those 2 lectures, and in those 2 lectures, we'll revise the concepts. As far as the clubbing provisions are concerned, you haven't received notes, is what some of the participants are saying. I did send the notes. I did upload the notes. I don't know why it's not available to you, but I'll re-upload it. Don't worry, and you'll get those notes. I hope you got the notes for deduction. Tomorrow we'll be completing all the deductions relating to payments, and thereafter on the last day we'll take up deductions which are linked to certain income and other miscellaneous provisions of chapter 6A. Rest be assured that it is relatively simple in your case. As far as the next level, that is final, is concerned, there are a few more complicated provisions which thankfully are not covered by your syllabus. You have to just read it a couple of times, and see, once you read ATC or ATDD once or twice, you would not find it difficult at all. You would not find it confusing at all. I have tried to maintain the language of the act. Priyanka is suggesting, why do we need to make it that complex? Well, I don't intend to make the reading of the slides complex. What I'm trying to make you understand is the provision in its raw sense. Once you understand the provision as it goes, you can always refer to the module. You could always refer to the summary and brush it up. Brushing it up is not difficult. You can do it as once you understand the provision, then you just have to brush it up. In fact, modules have got beautiful summaries at the end of the chapter. If you just go through those summaries, you'll brush up the entire provision. Well, thank you so much, friends. I hope you've enjoyed it. We'll continue with deductions tomorrow or day after tomorrow. I'll just leave the meeting.